Welcome back to the Wall Street Podcast. Today we're doing a deep dive into the Goldman Sachs Energy, Utilities, and Mining Pulse Report. It just came out August 8th, 2025.
That's right. It digests the Q2 earnings cycle, pinpoints stocks where analysts are feeling more positive or maybe more cautious.
And it gives those key macro takeaways, too. Our goal here is to cut right to the chase, give you the most relevant findings for, your investment thinking.
Exactly. It's that real-time pulse check post-earnings. Crucial stuff.
Okay, let's jump in. Exploration and production, E&Ps first. On the positive side, Expand Energy, that's EXE. They really stood out.
Strong results, yes, and impressive capital efficiencies, plus that hedge-the-wedge strategy they're using.
Right, that's their way of managing natural gas price swings, locking in profits. Pretty smart.
It is, and investors also like the clearer 2025 CapEx view and the real shift towards returning capital to shareholders.
Okay. On the flip side, Comstock Resources, CRK, shares traded down.
Yeah, that was mainly because they had to lower their 2025 production guidance. It seems driven by, well, midstream capacity constraints, unexpected ones.
So infrastructure bottlenecks.
Precisely. And the whole natural gas macro outlook is still a huge focus. Producer discipline, But it's worth noting, the 2026 Henry Hub curve is holding above Goldman's through-cycle estimate of $3.75 mmML beat. That's actually a pretty bullish signal long-term.
Got it. Moving over to utilities, Xcel Energy, XEL, looked positive.
Very positive. They've got a clear line of sight to another, $15 billion in CapEx.
Yeah, from transmission and generation projects.
And that directly supports almost 9% annual EPS growth. That's a solid, predictable growth story there.
But not all utilities were positive. Public Service Enterprise Group, PEG, more cautious notes there.
Right. Concerns about customer affordability in New Jersey, that was one thing. And also, maybe surprisingly, no big data center deals announced yet, even though inquiries are apparently up.
Interesting. And the broader macro for utilities.
Actually quite strong. Q2 power demand looked good across the board. AEP, NE, SO, XEL, all saw it. That underpins continued investment into the power grid.
Okay, finally, clean technology. Sunrun, RUN, got positive feedback.
Yes, better than expected volumes. And management's really focused on securing safe harboring.
That's about locking in the solar investment tax credits, the ITCs, right?
Exactly. It helps support their installation pipeline basically through 2030. So long-term visibility.
But Shoals Technologies, SHLS, faced some caution.
Investor concerns. Mainly about its margin profile. Even though, actually, the company's performance beat expectations.
So perception versus reality, maybe.
Could be. But the overall macro for utility-scale solar in the U.S. still looks robust. The safe harboring efforts across the industry are really helping ensure solid development pipelines through 2030. That's key.
All right, let's dig a bit deeper with some broader questions. Looking at this whole earnings cycle, what were maybe the defining stock narratives beyond the ones we just hit?
Well, it really showed wide dispersion. A real mix. Beyond EXE and CRK, you saw Chevron, CVX gain traction, strong volume, good free cash flow growth, mainly from big upstream projects finally coming online.
Okay.
But then you had CVR Energy, CVI, still cautious, waiting on dividend reinstatement. That shows a real focus, maybe more on the balance sheet for some rather than immediate returns.
Understood. And what about the big picture, the macro themes? Did this earnings season reinforce anything or maybe challenge existing views?
I'd say it strongly reinforced the resilience in natural gas demand, especially with LNG export growth holding up despite the price swings.
Okay.
And another big one, capital discipline and efficiency gains. That's critical across all these sectors. Companies are really focused on optimizing. Oh, and for refiners, healthy diesel demand looks set to keep margins elevated. That's a positive takeaway.
So pulling it all together, how are companies actually adapting their strategies now? What are the key moves?
Well, clearly prioritizing capital efficiency and shareholder returns. We saw that with Expand Energy, very disciplined. In midstream, it's all about locking in long-term volume contracts. Competition in NGL exports is fierce, so that's vital.
Makes sense.
And utilities, they're laser-focused on leveraging power demand growth, especially from data centers, to justify and drive these big, necessary infrastructure investments.
So these insights from Goldman really highlight a continued focus on energy supply, on infrastructure, that could definitely influence future utility rates for you, the consumer.
Absolutely. And the ups and downs in natural gas and fuel prices, those obviously affect everyday energy costs.
Plus, the stability we're seeing in clean tech, helped by policies like the solar ITCs, that impacts how quickly and affordably renewable options become available to everyone.
This report gives a really concise but quite comprehensive view of what's shifting and what's staying the same in energy, utilities, and mining. That focus on efficiency, smart investment, navigating the macro picture, that's going to keep shaping things.
Definitely something to consider for how these trends might impact not just your portfolio, but maybe your view on the whole energy landscape going forward. Until next time, keep digging deeper.